Hello and welcome to Livewire Markets. My name is Anna Dadich. Today I am joined by Steve Johnson, Chief Investment Officer at Forager Funds. He's going to be talking to us today about where active investors can find the overlooked opportunities in the small cap market. Steve, welcome.
Anna, great to be here.
Let's start with the big picture. Small caps have really struggled in recent years. What's the reason behind that underperformance, and do you think it's going to be turning around anytime soon?
I think there are a few contributors to it. One, the small cap index in Australia is not a great index. It's got a lot of revenueless biotechs and mining exploration companies, and just not owning those has made a pretty big difference to returns over the years. We've had this huge wave of passive investing, and most of that passive money is going to the larger end of the market. And I'd include the big super funds in that. They've been taking money away from actively managed small caps, and that makes a lot of sense for them. They're just so big that the small end of the market is fairly useless. So I think those things have contributed to index underperformance. It's actually been quite a bit better in recent years. And I'd also say that it's actually been a good space for active management. The median small cap manager, if you jump on Morningstar, the median small cap manager has done 4% per annum better than the index over the past 10 years. That not only is better than that small cap index, it's actually better than the All Ords index as well. So just by being invested with a median small cap manager, you've added a bit to your portfolio returns over time. So it's definitely not all been bad news.
Okay, so you've argued that small cap active managers actually benefit from the dominance of passive investing. How does that play out in practice, and how have you seen that in action over the past 12 months?
Yeah, I think the wave of money out certainly made everything pretty difficult for a few years there. But as things have leveled off recently, there's a lot of, I would say, ignorant is maybe the right word, or just thoughtless selling going on in our parts of the market. That's creating opportunities to buy stocks at really, really attractive prices. And then at the other end of the funnel, I think if you can find the right business that ultimately goes back into some of those indexes, not only are they trading at fair prices, they're trading at quite optimistic prices is probably the best way of putting it. So that range from there is no interest and there's no passive money and there's not a lot of coverage of the stock, for the same business, the valuation applied to it at the other end of the spectrum can be quite extreme. So if you can bridge that gap, there's enormous amounts of money to be made.
Okay, so in your recent article, you wrote that passive giants are dropping crumbs, but for nimble investors, those crumbs can be a feast. What do those crumbs actually look like, and how do you know when one is worth picking up?
Yeah, it's important to say that they are crumbs, because we were having this conversation in the office and someone was saying, well, I'm invested in an industry super fund and them not being invested in small caps is costing me money. But it's really a drop in the ocean. If they were invested in our Australian small cap fund, even if they gave us $100 million, which would be about all we would want to take into our Australian fund, and we outperformed the market by 20%, we worked out it's less than a couple of basis points of return, because Australian super, for example, is so big. They've got $370 billion of funds under management. And for them, cutting fees is far, far more important than any outperformance they can get from small caps. So it really is crumbs. And I think for them, the shift to low fees, hug the index is the right thing for them to do. But those little crumbs that come off when you're our sort of size, they can actually make enormous difference to your portfolio. So Catapult's an example we've talked about a lot, but it added more than 10% to our portfolio in a 12-month period just from one stock. And it's one that's been able to bridge that gap. So that's why it can be an enormous feast for smaller investors.
You've mentioned that price agnostic selling creates some of the best opportunities in small caps. What's an example of a stock Forager bought because it got booted from an index, and how did that play out?
Yeah, I'd say there's always a combination of reasons. So for us, it's not our company got booted from index, we want to buy it. But we always, when we buy a stock, sit there and say, well, why is someone selling this? What is the reason for it being cheap? And I would say increasingly getting booted from an index is a contributor to the downwards momentum that a company was already suffering. And for us, probably the quickest turnaround example of that is Johns Lyng recently. That company was a darling stock a few years ago. It not only went into the ASX 300, but it was actually in the ASX 200. a couple of missteps. It disappointed the market. The share price started to fall. In March of this year, it actually came out of that ASX 200. It would have come out of the ASX 300 as well. It was only a matter of time given where it was at. So on top of disappointed larger active managers, you then get the passive selling, and the share price was $9 all the way down to $2. And we'd been watching that stock pretty closely from $5, and I think that the end momentum sell-off there was really the opportunity for us to get involved. So it wasn't the only reason. There's lots of stocks that have been booted out of the index that we didn't buy because we didn't see the potential for them to grow back into something bigger again. But Johns Lyng's probably the best example over the past year.
Okay, so what about thematic waves? How are you navigating the rise and fall of trendy ETF flows? And are there any companies you've picked up that were oversold for no good reason?
Yeah, I'd say Australian investors might not be noticing this as much yet. It's much more prevalent in the US, where you can go and buy a home builders ETF, for example, and that home builders ETF just owns all companies that are exposed to housing construction in the US. And when people want to bet on housing construction speeding up or slowing down, they go and buy and sell this index, and every single company that's in that index goes up when the money's flowing in, and they go down when the money's flowing out. And these waves have been really extreme. So one of our best investments over a long period of time on multiple occasions is a company called IBP. They do housing insulation. It's a great business. The earnings march up over time, and we've had 3 chances to buy the same stock on these momentum swings. And more recently, a company called Comfort Systems. They're actually heavily involved in the data center construction business in the US. They do high-end heating, ventilation, air conditioning systems, and data centers has been big for them. We saw in February, March, April, there was a bit of news from Microsoft about slowing down their demand for data centers. It had been a hot sector, the money flooded out, and the share price of that company halved. It went from $500 to $300 in the space of a couple of months, and no one's estimates of the company's earnings changed. It was literally the same business, same earnings, share price had halved, and we'd been waiting on that one for quite some time. So it was a great chance for us just to get out there and buy it, and the optimism has come back and the share price is back at $500 again.
How do you evaluate whether a small company has the potential to be included in an index, and what does that mean for returns?
Yeah, again, it's a factor for us, not a be all and end all, but is this, and particularly when we own something that is going well, where the business is growing and there's a bit more attention coming to it, it's an important consideration for us. Is there some chance here that this is going to get really optimistically priced because it goes into an index? So here in Australia, that's a pretty straightforward exercise around how big the company needs to be, what sort of volume needs to be traded in the shares. And that $1 billion market cap is a pretty nice sort of cutoff for people to keep in mind. So for us, we work backwards from there and say, how much revenue would it need? What profit would it need? What sort of multiple would it need to trade at for it to start going into one of those indexes? And usually at the small cap end, that needs to be something that's going to grow. There's not many companies that are just going to, sentiment-wise, turn around with the same amount of revenue and people are going to double the multiple that they pay for it. So usually for us, we're sort of back solving to say, how much revenue does this company need to get to before it's going to trade on that sort of multiple and then go into an index? And like I said, it's not exclusive for us. Some of our best performers in the past year are not companies that are ever going to go into an index. It's just a really important consideration in terms of how we maximize the profit and how we think about the balance of the portfolio. How long do we want to hold on to this stock? Well, is it going to be perceived very differently is an important consideration.
Mm-hmm. So let's talk about Catapult, which we mentioned just before. It's gone from a tiny trade to a 5-fold return and entry into the ASX 300. What first put it on your radar, and what gave you the conviction to stick with it?
The company's been on my radar for a long time. I run through the stadium precinct here in Sydney on my morning runs very, very regularly, and every single sporting team that's outside the stadium doing their training sessions has got Catapult stuff set up around the outside. And in the 10 years that I've been running through that park, that's gone from the Sydney Swans and the Sydney Roosters, 2 big elite teams, to their junior squads are using it, the women's teams are using it. The proliferation has been very, very obvious. And this company has been listed since 2016. So I've known about it and I've been interested in it. And I've been a bit frustrated that it had not been able to generate a profit. So it had been growing, the revenue was going up, it was burning cash. There wasn't a lot of evidence that was going to change. And then a new management team came in 4 years ago and laid out a really clear path here for what this business could be. The first bit was we actually need to spend more money, and the share price tanked again on the back of that. But at the same time, they said once we've spent that money, this business is going to grow, and each dollar of growth is going to translate to this much extra profit for shareholders. And we weren't super confident in that. It was a pretty small portfolio waiting for us to start with, but we got 1 result, 2 results, 3 results, 4 results, and we really upsized that investment as the evidence started coming in. Not only are they saying the right things here, they're actually delivering on it. And that's been the big change for Catapult. I don't think anyone would have had a dramatically different revenue number 5 years ago for this company than what they're going to deliver this year. But now it's generating cash, and they're pointing towards 5 years down the track, generating a lot of cash. And that's been a dramatic transformation. And then it's got big enough and liquid enough, and overseas investors have got interested in the business. It's global in scale. And there's lots of reasons why people are excited about it.
You've said Forager wants to stay small. Why is that important, and how does that give you an edge over larger managers?
Yeah, I mean, the crumbs need to be big enough to feed you, and for us that means staying as small as an ant that can make a dinner out of that. And there's even, I'd say, a tier for us that's underneath some of the larger small cap managers. We want to be able to find and own these companies a year or two before some of the larger small cap managers own them, and then they ultimately go into the indexes. So I find that 150 million to 300 million market cap's a really nice sweet spot for us, and we just want to make sure that as a business, we've had clients be very loyal to us over a long period of time, and it's my view that if we stay at that size, we can continue to deliver them very good performance. If we get too big, it's going to deteriorate from it. So that's reason number one. Reason number two is I actually love it, that part of the market, and finding a business that people are not that familiar with and don't know that well. It's just what I enjoy doing, and I want to get up and do every day. And we can have a good business. We want to be bigger than we are today, but we can have a good business at still a relatively small size, and I can enjoy my life.
So with all that said, what does your portfolio look like right now? Are you leaning more into these forced seller opportunities, or is it more about positioning for future index inclusions?
That pipeline of new stuff is pretty consistent, so there's no shortage of things for us to be looking at the moment. And across both of our portfolios, it's been a pretty significant reset over the past 6 months. I think some of the things that have worked really well for us are now fairly fully priced. We've talked about Catapult. That was a 10% weighting 6 months ago. It's now less than 5% in our Australian fund, and the new opportunities have grown there. So that's a really important element to it. I'd say on our international fund, it's also been a pretty significant shift away from the US. We're really excited about some of these Japanese software stocks. That part of our portfolio has grown quite significantly. The valuations are fractions of what they are here in Australia and in the US. So they're both portfolios, I think, that are quite different from what they were 12 months ago. And I think across the market, that's going to be important. It's been a big run in some small parts of the small cap market, and it's important that portfolios are refreshed.
Finally, looking ahead, with passive investing here to stay, how do you see the role of active small cap managers evolving over the next 5 to 10 years?
Yeah, I think it's a really exciting time. I think it's a space where it's been a drag for a long period of time. I think everyone's looked at the returns and said, well, why do I even need to go to that small cap part of the market? And I think, like I said, not just us, a lot of our peers as well, there's people generating really good returns in the small cap part of the market. And I think this trend towards passive keeps going, but there will always be people that want to allocate money to people that are making money for them. And I think in some ways our job's easier than it was because of these passive flows. And I'm quite excited about what the next 10 and 15 years can bring.
Okay, great. Thanks for joining us, Steve, and sharing your insights, and looking forward to our next chat.
Thanks for having me on.
If you enjoyed that interview, please give it a like, and don't forget to subscribe to our YouTube channel where we release new content every week.